Let's see here. Okay, so welcome to Heritage Wealth Planning, my friends. I just came across this incredible video from Vanguard, the Vanguard Group, the behemoth of mutual fund industry for sure. I think they manage $4 or $5 trillion in assets. So when Vanguard talks, people listen. All right. So when Vanguard talks, people listen. Their expectations for the forward 12 or 10 years, i.e. the next decade, for stock market returns is going to blow your mind. You need to follow this when it comes to your retirement planning, because Vanguard has just pulled the cover off and we're seeing the man behind the curtain here and what the projections look like from the behemoth, which is known as Vanguard, is going to blow your mind. It's going to change everything when it comes to your retirement planning, and you better just pay attention. And this is why I talk about paying off debt is the easiest thing to do to make sure you're increasing your net worth. So basically, historically, the stock market has returned about 9 to 11%. All right, we've had 9 to 11% going back to 1926, which is basically the modern era of stock market investing. Now, that's from 1926 till basically the last, I guess, 2017. And how you typically get that is you take earnings growth year over year plus dividends. Earnings growth year over year is about 6%. Dividends is roughly 4%. You add those two together, and that's your 10% nominal rate of return. Pretty simple. Sometimes earning growth might be 7. Sometimes dividends might be 3. At the end of the day, that's just an easy, quick number to get the calculation for returns. Year over year earnings growth plus dividends. Well, here's the issue. Vanguard is saying that's going to change significantly. They're not expecting typical 6 to 7% year over year earnings growth. We're certainly not getting 4% to 5% dividend yield. We're getting about 2% right now. So what Vanguard is saying is at the end of the day, for the next 10 years, they're expecting a 3 to 5% nominal rate of return for stocks. That's not bonds. That's stocks. 3 to 5%, my friends. That's less than half. That's a third, essentially. So if you have a 9 to 11% historically, you got 3 to 5%. That's a third to a half of historical norms. Now it gets worse because nominal means before inflation. So Vanguard is saying that inflation will probably be high 1s to low 2s. So we'll just say 2%. So what you do is you take, I'll write it down right here. 3 to 5% nominal. As you can see that, look at that handwriting, 3 to 5% nominal. We take care of inflation, which is, we'll just say 2%. And that gives us a 1 to 3% real. Right there, 1 to 3% real return. So you got 3 to 5% nominal. Nominal is before inflation. And you subtract the 2% roughly that Vanguard is expecting, which is a little bit lower than what the Feds are anticipating or their target is. You get a 1 to 3% real return over the next 10 years. And that's in stocks. So let's look at bonds. And bonds are easy. Actually. Stocks are hard because we can't really predict what the over year-to-year earnings growth is going to be. It's 4, 5. Maybe if with various tax cuts and whatnot, stimulus, we can get 6. That seems tough to me, simply because we've had all kinds of stimulus from the Feds before with easy money, and now it's going to be more on that's on the monetary side. Now it's going to be more on the fiscal side with tax cuts and whatnot. But at the end of the day, the easy money is behind us. The Feds aren't doing that anymore to the extent that they were during Obama's years. Rightly or wrongly, doesn't matter. We're not having easy money like we did before. Now we're going to have fiscal ease with the tax cuts. In fact, I just read an article that corporations are bringing billions of dollars back, repatriating it from overseas to put back in the U.S. That's fine. That'll give you a boost to the tax revenues that the Feds bring in, but certainly not, and it'll probably give a little boost to the economic growth. I mean, they got the money here, they're going to spend it here. The velocity of money is what we call in economics. But at the end of the day, is that long-term year-over-year earnings growth that you can hang your hat on? And the answer is no. So let's look at bonds. We'll say bonds pay, see a 10-year treasury now is at 2.85%. 2.85 is a 10-year treasury. Let me write that down. T-bond, which is the proxy for all interest rates, my friends. A 10-year is a proxy. Inflation, 2%. That's what you're getting right there after inflation, 0.85%. And that's locking up your money for 10 years. All right. So if Vanguard is even half right, let's just say they're 50% off. All right. So now they're going to say instead of getting 1 to 3% real return, they're getting 2 to 6% real return. You still got to factor in taxes. And on this right here, this is the bond. 0.85 is before taxes, because don't forget you pay tax on your inflated value. And I'm not going to get into that here today, but the taxes are another big issue here. You don't pay tax on the net, on the gross. You pay tax. You don't pay tax on the real return. You pay tax on the nominal return before inflation's figured out. I know it's confusing as all can be, but just remember, you pay tax on the inflated value you're getting. And I've done videos and podcasts on that. And if I can find it, I'll post it in the show notes here. But let's just say Vanguard's half right. 2 to 6% rate of return, real in stocks. Bonds, it doesn't matter. I mean, bonds are simple. You take your rate of inflation, you subtract that by, or you take your total coupon that you're getting, say 4% or 3% on a 10-year treasury, doesn't matter. You take your rate of inflation at 2% and you get that. So if you're getting 2.85 on your 10-year treasury, you get 0.2 or 2% on inflation, it's 0.85. That's really that simple. So you combine those two, you got 0.85 on bonds, and we got, say, 4% on stocks. You go 4.85, divide that by 2. That's 2.425% real return, my friends. And that's a 50% stocks and 50% bonds. Hey, that's before taxes. Something to chomp on. Something to chomp on. I'll put the Vanguard link in my show notes. I did post it to my website. They allowed me to embed the video, which is fantastic. It's only a 3-minute video. You should watch it. But at the end of the day, the days of 9 to 11% rates of return, gone. Now, could they come back? Sure. It's all contingent on earnings growth year over year. And if earnings growth doesn't kick in at 6, 7, 8%, there's just no way. It's just no way we're going to get a 9 to 11% rate of return. Nope, ain't going to happen. Market here first. So what can you do? You can pay down debt. Absolutely. That's the number one thing you do, give yourself a net rate of return. Because paying down debt does not increase taxes. You have less cash flow going out in the future. And if the markets don't do what we think, and you still have that debt, you're losing money hand over fist. So don't do that. And then I can't even talk about taxes, because taxes are another issue that we're not talking about here today. So hope this helps. I mean, if you have any thoughts on that, I'd love to hear them. But Vanguard isn't, they're not a Nervous Nelly group here. I mean, they are the biggest asset manager in the world. When Vanguard talks, you need to listen. And they're talking right now. And that's to be careful, be cautious. And my addition to that is pay down debt, pay down debt, pay down debt. If you like what you hear here, thumbs up, always helpful, my friends. Don't forget to comment down below, show notes, or go to my website at heritagewealthplanning.com and hit that little button there to subscribe. You see that little subscribe button down there, hit that. And then don't forget the little bell to be notified of future contents. We'll see you next time on the Heritage Wealth Planning YouTube channel. Thanks, guys.